today, what I'm going to be talking about are some of the misconceptions about technical trading. It's really, really interesting because there's a lot of people that want to get into technical trading. They see that there's an amazing technology that's available. They see that the technology can allow them to see what's happening in the markets and to really assess the support and resistance, supply and demand, and all these different concepts, and hopefully help them trade better. So in the process of talking to people over the years and watching their journey, and actually my own personal journey over 20 years ago, one of the things that I found is that there's a huge misconception out there that many novices have, and even many experienced traders have, that I believe can limit their results. And what that misconception is that they could use the technical indicators that are called oscillators. Oscillators are, and I'm going to define that here in just a second, but oscillators are very common and they're found in most technical packages. You can get it for free anywhere online that has technical data. And the misconception is that somehow we can take those oscillators and then we can optimize them by looking at the number of days in the past, a look back period based on days or weeks or months. And we can test that, and we can run through a bunch of different parameters and optimize over data that we're looking at, whatever markets we're looking at. And what we do is we find what is the best number of look back days we can have that's going to give me the best buy and sell signals. That's going to give me the highest accuracy. So I want to be, 70% accurate, 80% accurate. And if I'm able to do that, then I can make more money. So that's kind of the logic that a lot of technical traders have. I can use oscillators. I can use these technical indicators. I can optimize them. Therefore, I get better accuracy. And then from there, I can make more money. So I want to just talk about that misconception and actually provide some remedies that through my experience and through analyzing the performance of systems that I found to be actually much more effective. Okay, so first let's define what an oscillator is. An oscillator is a technical indicator that measures the movements up and down around a center line. And basically what these indicators are trying to do is kind of detrend the price action of the market, take the trend out. And there's usually a middle line it could be 0, above or below 0, or it could be 50. And sometimes these indicators are bounded. They may be bounded and constrained so that they're only going to be between 0 and 100. Or they might have trigger lines which indicate when it's overbought and oversold. And that's really the general concept, overbought and oversold. Most oscillators are used for that, to basically say, if this indicator gets really high, then it's overbought and therefore I should sell. And if the indicator gets too low, below a certain level, then I should buy. Okay, so it's kind of like, if you think about an analogy here, it's kind of like a horse on a carousel. When you were a kid and you got on a carousel, I remember I took my kids to Disney World in Florida, and they have this really big, great carousel, really cool. And as it's turning around, you could see that horse moving up and down, and that horse moves up in a specific time period, up and down, and it goes a certain amount up and a certain amount down. That's kind of what an oscillator tries to force the market into. But we have a really big problem. The market does not act like a sine wave. And I'm going to show that. And I'm going to actually give you some remedies to think about. This here is a chart of a company called IQVIA. IQVIA is a medical company. They provide medical R&D services to biotech companies and to pharmaceutical companies. And one of the things I wanted to show you was that here is a market. Here's a stock that is moving in a way that is favorable for oscillators. And I wanted to show that. So what this chart shows is there's 3 different oscillators. There's an oscillator for the stochastics on the top, and then there's an oscillator for the RSI in the middle, and then below there's an oscillator for the MACD. And these are the most common oscillators that you see. Stochastics, that I'm using here are a 10-day stochastic, and then the RSI is also 10 days. And the MACD is the kind of the default at 525.5. And I'm not going to go into the calculations of explaining all of the intricacies of how these are calculated. You can look those up online. My point is, when you have a market that is moving in an up and down profile like it is right now, and it's really making no price progress, this is called an equilibrium. We call that an equilibrium state. Some technicians call that a basing state. And what that really means is that buyers and sellers are generally balanced. No one's really in control on the buy side. No one's really in control on the sell side. The market's balanced. And what we have is an oscillating market. We don't really go up. We don't really go down. We move up and then come down. We move up and come down. We have support and resistance. And in that environment, you can see in these vertical lines that are here on this chart, in that environment, you really do have some decent signals. If you get your parameter set right, you can get some decent signals. So if you're doing a back test, and you try to sense those conditions, those time frames, you're making an assumption that that's going to hold in the future. And what I want to show is that in this chart, this is a chart of the S&P 500. And this is a pretty long-term chart. And I wanted to show some cycle analysis to show that the markets do not act in a consistent way cyclically. There are many people that say that it does, but when you look at the analysis and look at the observations, it's kind of spotty. Sometimes they'll cycle very consistently and sometimes they won't. And these cycles don't really sum up like theoretically there's a theory out there that somehow they sum up and then that's kind of how it all works. There's mini cycles and then cycles that are a little bit bigger and cycles that are a little bit bigger. And if you add them all up, you get, you can forecast the price. In my analysis, that's baloney. And I want to show you right here. If you look at this cycle, you can see that sometimes these highs and lows match in the market. I'm just using one example. We could apply this to currencies. We could apply this to commodities, bonds, and you'll get the same result. Now, on the bottom of this chart, I have something called a Fourier analysis, or some people pronounce it Fourier analysis. And what it is back in the day, there was some engineers, and I don't know the exact names of the engineer, but there was an engineer or set of people that came up with an analysis that could actually try to take a data set and find out where the cycles are, like a sine wave cycle. And they applied it to the vibrations of an airplane wing. So the wing of an airplane moves up and down, and I guess for some structural reason, they needed to know what that cycle was like. And that has been applied to the stock market and to markets in general to try to find cycles. And what this indicator on the bottom is really showing is that you really don't have a consistent cycle in the markets. Okay, so I think I've made my point there. So now one of the things I want to talk about is when you have a cycle that's working, one of the things that we want to do is we want to be able to remedy the problem that cycles aren't consistent, and we want to be able to put things in context. So the number one thing to do in order to actually make oscillators work for you is to understand the three major types of trends that are involved and how an oscillator will work in those three different types of trends. So the first type of trend that we talked about was equilibrium. So in a period of equilibrium, the oscillators can help. So we first need to say, well, how do we know we're getting into a period of equilibrium? Well, one of the first signs that you'll get is that the price action will tend to move into the moving averages. So this chart here is showing IQVIA again, and I put on a couple of moving averages so you could see that as we went into this equilibrium state, this basing state, you see the moving averages moving into the price action. There's many crossovers. So you'll see crossover, and whips and saws. And then you'll see certain levels where the market will clearly sell off and consistently sell off in those areas, and then consistently buy in those areas. And you can see in these two zones here on the top two lines, those are kind of resistance zones between 105 and 108. And the bottom is support zones at 94 to 97. So the resistance zones are areas of selling where sellers have stepped in, and supporting zones are areas where buyers have stepped in. So that's one of the first things you can notice when you are entering into a basing phase is we've come up out of a trend, and then you start seeing moving average crosses happen more frequently. And the other key is that you see support and resistance levels being actually holding. So, you see that action start to occur up and down. The third thing that I think is really important is that you'll usually see volatility start to increase. The bottom part of this chart is an average percent range, which is a daily volatility figure. And you can see that the downtrend in volatility broke. And as we got into that base, that volatility started to increase. So those are some of the ways to kind of sense that you're heading into that area, and to adapt to how you're going to use an oscillator. Okay, so now I want to show IQVIA's moving into a trending state, which is the second area that I want to talk, or second type of context to use a oscillator in. So we went through this period of time, and then we broke out. You can see we broke that 108 level, and we start to trend. So now we're in a different state, right? We're in a state of trending. And when you're in a state of trending, what will happen is the oscillators will tend to give you overbought signals if it's on the upside, or oversold signals that are on the downside. And it'll give you a lot of false signals because the market is now trending. It's going to tell you to get out, but really you shouldn't. You should stay in. So IQVIA is in that state here. And one of the first things that you can notice when that is happening is just, first of all, you break out of a range. And second of all, you tend to see the moving averages being further away from the current price. And you can see here, like the green moving average on this chart is further away from the price action of IQVIA. So that's one thing that you want to look for. Now, even before you break out of the range, there are some clues that you might start to move out of a range. And so once a base is mature and it's had time to work itself through, where the either the buyers or the sellers start getting in control, you want to look for clues that which direction that we're going to go. And one way to look at it is divergences. So like in this chart, a divergence is when you start seeing higher highs. For example, in this case, you saw higher highs happen. Higher lows happening. And that was kind of an indication that maybe we were going to go test the upside of that range and break out into new highs. The other part of this that I want to point out is that in our process, the fundamentals and having a variant perception, a perception that about where the direction should go based on valuation and fundamentals, is key. So in IQVIA's case, we had a positive outlook on the company based on their earnings and based on the products that the services they were providing, and their competitive advantage, and based on their cash flows and what the price was trading at right now relative to the cash flow. All of those things led to a positive perception about where the stock should go. So that's kind of the fundamental backdrop. So I think when you add that to your analysis, you can get even more accuracy and even more probabilities of having a winning investment trade. So that second part in context is to look at the trending phase, in which case that we no longer have these great buys and sells, ups and downs from the oscillators. Basically, the overbought and oversold will tend to give you false signals. All right, so now I want to talk a little bit about Grubhub. Grubhub is just an example to show you those false signals. You can see here as Grubhub pulled out of that base above 45, that horizontal line at 45, what happened was the oscillators were all in overbought territory. Overbought, meaning sell, right? But what happened is if you had sold those, you'd have missed out on a move from 45 to 120 plus. So that's the danger of overbought and oversold indicators, and one of the reasons why optimizing is not really ideal. Now, the third state that I want to really highlight is the state of being extended. And it could be an extension higher or extension lower. And I want to use Bitcoin as an example because Bitcoin is one of those cases that's really kind of a classic case of an extension. First of all, you can see this is a chart of Bitcoin. And first of all, you can see that the cycles that were optimized in the past really didn't work in the future. And they decoupled. So I just kind of wanted to reiterate that point that the cycles don't stay consistent. And second, I want to point out that when you have a situation where you have a parabolic move, then these oscillators can be helpful again because they can help you in timing a parabolic move that's about to end. So an exit. So if you were long Bitcoin and the oscillators start giving you sell signals, then they have a little bit more of value than when you are in an initial stage of a trend. So, but in Bitcoin's case here, we saw a parabolic move accelerating higher. You can see that with that red parabolic trend line that I put on this chart. And then you also notice that, one of the common things that you see is that you have a situation where, you have a situation where the fundamentals are not justified by the price, or market participants aren't even thinking about the fundamentals. They're just, and in Bitcoin's case, it's kind of hard to even come up with fundamentals. So any parabolic move in any direction would be hard to justify, because you really have a very difficult time having a basis or understanding a basis on how you could even make an economic case for it. So, there's some theoretical things, but there was no cash flow reasons, or, it's not even really a currency yet. It's just, and I'm not saying that this is a bad thing and it will never work out or whatever. What I'm saying is that at the time of this accelerated move, as of that time, there's still no fundamental case. And so that was a really classic sell signal. So an extension, the point on this is that during an extension, oscillators become more valuable again, because they can help you exit an overbought or oversold condition. It's really, really handy. So now I want to talk a little bit about one of the third kind of subsets of the misconceptions with this optimization, this whole logic of I can optimize, find the right number, and then have buy and sell signals. And the big part of that is a misconception is that somehow if I can get more accurate in my trading, then I'm going to make more money. And the reality is, with system trading and with trading in general, that it's not so much how accurate you are. That's not the most important thing. What's more important is how much money you make when you're right versus how much money you lose when you're wrong. And are you able to manage your position sizes? Those are the two most important things. In fact, it's more important than your accuracy. I'm not saying accuracy is not important, because it is important. But it's not as important as the other two, because you can control the other two. Your accuracy rate will come in and out of favor. It'll change. In fact, some of the most professional, highest return traders have even said, like for example in the Market Wizards, that they're only right, 20, 30% of the time, 40% of the time maximum. So if that's the case, well then how in the heck are you making so much money? And the answer has to do with your average win versus your average loss. And what this chart shows is that managing risk is the key. And what this chart shows is the break-even reward risk of your trades with various accuracy of your trading. So in other words, how big does your average win need to be compared to your average loss? And that's a ratio, average win divided by average loss. How big does that, what number does that have to be in order for me to break even at various levels of accuracy? So as an example, if I'm 50% accurate, my average win to average loss ratio could be 1, and then I'm going to break even. So if my average win is anything, average win to average loss ratio is anything bigger than 1, then I'm in profit territory. So really, it's the spread between your average win and your average loss that you want to maximize. And there's two things that must be done there. The first is let your winners run. And I know that sounds trite, but when you're on a winner, increasing position size, holding it longer, that's really, really important. Recognizing when you have your winners, and then to really truncate your losses short. Make sure that you don't let them get ahead of you, because if they do, then one single loss can take out more winners. So one single loss can take out lots of winners. Now, the other element of this, it has to do with your position sizing. How much you put on is super, super important. If you put on not enough, then you're going to be in a position where you're not going to really capitalize on it. And if you put on too much, then your risk profile will be unacceptable, and you can have just a few trades blow up your performance. And when drawdowns occur, and could be really a whole other segment, but when drawdowns occur where your value of your portfolio is going down, it's much more difficult to recover. So it's a balancing act. And I have another piece on the three primary balancing acts that traders and investors must master in order to be very successful. All right, so just to summarize about this common misconception, it's really important to have a perception, a variant perception about the direction, something that's going to give you a longer term direction. That in our process, that really helps a lot to guide how things work. And it's important to understand that assessing the phases of the trends that you're in, where are you? What conditions are you in now? That tells you how to use your oscillators. So if you're in a basing situation where markets are in equilibrium, then you can have better accuracy and better mean reversion type trades. If you're in a trending when buyers or sellers are in control, one or the other, uptrend or downtrend, then you're going to have a lot of false signals, and then the cycles aren't going to stay consistent. You have to always keep that in mind. When you're in an extended situation with over optimism and pessimism, then these oscillators can become more valuable again. And just to keep it in mind that really your smart trade management is much more important than any of this optimization business. It's better for you to understand your average win, average loss ratios, monitor how you're trading, and to do a post analysis. Don't worry about your accuracy as much. Try to get as accurate as you can, but that's not the key. It's maximizing that spread between your average win and your loss, which means truncate your losses and let your winners run. And also your position sizing. Having a great position sizing strategy will help you with the problem of inaccuracy. And it's really, really important. And that could be also another segment alone just on position sizing. So variant perception, assess the phase of the trend, use smart trade management, much more valuable than optimization. And please, if you're new to investing, try not to spend too much time on the optimization of oscillators, because it probably will not, most likely will not give you too much increase in results. I hope you find this valuable. This is Llanes with Wealthnet Investments signing off for now, and happy trading. Our market calls are not investment advice. It is information you can incorporate into your own investment strategy. And as always, do your own homework, assess the risks, and invest in light of your own personal goals.